The housing downturn so many people have been expecting isn't something that's still on the horizon. It has already begun. The difference is that it hasn't unfolded everywhere at the same time. While many news reports continue to paint a picture of stability, home prices are already declining across more than 100 major housing markets in the United States. In several cities, the number of homes available for sale has climbed by 30% to 40%, putting growing pressure on prices. Homeowners are watching their equity shrink, and in parts of Florida, nearly 1 out of every 10 owners now owes more on their mortgage than their property is currently worth. This is no longer a prediction about what might happen in the future. It's a trend that is already unfolding. In some markets, homeowners have seen property values drop by $50,000 to $100,000 in less than 2 years. Other areas continue to decline month after month as buyers remain scarce. The appearance of a strong housing market is beginning to break apart, and it's happening quietly, unevenly, and far more quickly than most people realize. Number 10. Fort Myers, Florida. At first glance, Fort Myers still appears steady, and if you only looked around the neighborhoods, you might think everything is holding together. But the data beneath the surface tells a much different story. Home values are no longer climbing because of genuine market strength. Instead, prices are being supported by sellers who are reluctant to accept that conditions have changed. Since the end of 2023, the median home price across the Fort Myers-Cape Coral metropolitan area has dropped by more than 7%, while the number of homes available for sale has jumped by over 35% compared with the previous year. That kind of increase isn't just a normal seasonal fluctuation. It points to a deeper imbalance between supply and demand. What many people fail to recognize is that Fort Myers isn't driven solely by traditional home buyers. It's also a market heavily dependent on investment income. During the housing boom, more than 42% of purchases were made for vacation homes or investment properties, with many buyers locking in extremely low mortgage rates between 2020 and 2022. Today, those same owners are dealing with a completely different financial reality. Occupancy for short-term vacation rentals has fallen by roughly 18% to 22%, while average nightly rental prices have slipped by nearly 25%. At the same time, insurance costs have surged. In Lee County, the average homeowner's insurance premium has climbed to more than $4,800 a year, compared with roughly $1,600 before 2020. For many property owners, that increase alone is enough to erase much of the profit from renting out a home. And the financial pressure doesn't stop there. Property tax assessments are also rising because they're still being adjusted using values from the market's peak, even though home prices have been moving in the opposite direction. That creates a painful combination of higher ongoing expenses and declining property values, squeezing owners from both sides. Recent listing statistics reveal that more than 51% of homes currently on the market in Fort Myers have already undergone at least one price reduction. Properties are also taking far longer to sell, remaining listed for an average of 78 days instead of the roughly 21 days seen during the height of the buying frenzy. Another important shift is happening behind the scenes. The steady stream of new residents that fueled this market for years is slowing rapidly. Between 2022 and 2024, net domestic migration into Southwest Florida declined by more than 60%. Retirees are becoming more cautious about relocating. Investors are quietly selling and moving on, and home builders are increasingly offering incentives equal to 8% to 10% of a home's purchase price just to attract buyers. That's a strong indication that demand is no longer keeping pace with supply. This isn't full-scale panic, at least not yet. It's the stage where optimism lingers even as the fundamentals continue to weaken. Many sellers are still pricing their homes as if it were 2021, while buyers are making offers based on where they believe the market will be several years from now. Housing markets rarely unravel when fear reaches its highest point. More often, they break down when expectations finally catch up with reality, and reality becomes impossible to ignore. Number 9. Denver, Colorado. Denver's housing market isn't showing signs of a dramatic collapse that grabs national headlines. Instead, it's weakening in a much quieter way, and that gradual decline may be even more concerning. Rather than falling apart overnight, the market is slowly losing strength, with each passing month adding more pressure beneath the surface. During the past year, more than 90% of homes across the Denver metropolitan area have experienced a decline in value. That figure rarely makes the news because overall prices haven't plunged in spectacular fashion. But housing markets don't always unravel through sudden crashes. More often, they weaken through steady, persistent erosion, and that's exactly what's happening in Denver. From late 2024 into early 2025, average home values slipped by roughly 6%, including monthly declines approaching 1% during the winter, a season that has traditionally been one of the city's more stable periods. At the same time, the number of homes listed for sale has quietly increased by more than 28% compared with a year earlier, while the pool of active buyers continues to shrink. Properties now remain on the market for an average of 62 days, nearly 3 times longer than they did during the height of the pandemic housing boom. One factor that's often overlooked is the type of buyer that fueled Denver's rapid growth. Much of the demand didn't come from local families. Instead, it was driven by remote technology workers and high-income professionals relocating from states such as California, Washington, and New York. That trend is now moving in the opposite direction. As more companies require employees to return to the office, many workers are heading back toward the coasts. At the same time, Denver doesn't offer the same salary advantages that originally attracted many of those transplants, making it harder to retain them over the long term. The result is a growing number of departures while many homeowners remain tied to mortgages taken out near the market's peak. Ownership costs are also continuing to climb. Property tax reassessments have pushed taxes 20% to 30% higher in some counties, and homeowner insurance premiums have been rising despite Denver's relatively modest exposure to major natural disasters. On top of that, homeowners association fees in many newer communities frequently range from $400 to $600 per month, adding another significant expense that steadily reduces affordability. Even though home prices have softened, the monthly mortgage payment required to purchase a median-priced home in Denver remains more than 70% higher than it was in 2019. For many buyers, financing costs continue to outweigh the benefit of lower asking prices. Perhaps the clearest warning sign is the sharp decline in pending home sales, which have fallen by nearly 15% compared with the previous year. Since pending sales often reflect future closed transactions, this suggests additional downward pressure on prices could still be ahead. Denver hasn't reached the point of a full housing collapse. However, it is steadily losing the buyers who once powered its rapid growth. And when a market built largely on lifestyle appeal begins losing confidence instead of gaining new demand, prices rarely level off overnight. They usually continue drifting lower until financial reality outweighs optimism. Number 8. San Jose, California. San Jose isn't experiencing the kind of housing downturn that most people picture. Instead of collapsing suddenly, the market is gradually giving way under the pressure of its own extreme prices. Ironically, being the most expensive housing market on this list is one of the biggest reasons it's now becoming increasingly vulnerable. Over the past year, home values in San Jose have declined by nearly 9%, and the pace of those losses has continued to pick up, even as major technology stocks remain close to record highs. At first glance, that may seem confusing, but there's an important distinction many people overlook. Strong stock prices don't automatically mean a strong job market. Since 2022, the Bay Area has lost more than 120,000 technology jobs, with San Jose sitting at the center of much of that slowdown. Many of the high-income workers who once fueled bidding wars are no longer rushing to purchase homes. Instead, they're choosing to wait, continue renting, or leave the region altogether. Meanwhile, the supply of homes for sale continues to grow. Active listings have increased by roughly 30% compared with a year ago, and price reductions are becoming far more common, especially for properties priced between $2 million and $4 million. Affordability has reached a point where simple math is working against the market. The median home in San Jose still sells for around $1.4 million. But with today's mortgage rates, property taxes, and insurance costs, the monthly payment can easily exceed $9,000. Purchasing a home at that level comfortably often requires an annual household income of more than $300,000, and the number of buyers who meet that threshold is becoming smaller rather than larger. Another important factor is the gradual shift among longtime homeowners. Many residents who benefited from California's long-term property tax advantages are now retiring or relocating, placing more homes on the market. The problem is that there aren't enough qualified buyers able to absorb that growing inventory. Commercial real estate is also adding pressure. Silicon Valley office vacancy rates remain close to 25%, reflecting a lasting reduction in demand for office space. That weakness affects more than just businesses. It also influences consumer confidence and expectations for the local housing market. San Jose doesn't need widespread panic for prices to continue falling. It simply needs time. When a housing market depends so heavily on a relatively small group of extremely high-income buyers, even modest changes in employment, income, or buyer confidence can produce much larger swings in home prices. This isn't simply another story about the technology industry struggling. It's a reminder that when property values become disconnected from what most buyers can realistically afford, economic gravity eventually begins to pull prices back toward reality. And over the long run, gravity almost always has the final say. Number 7. Jacksonville, Florida. Jacksonville may be one of the most misunderstood housing markets in the country today. At first glance, everything appears fairly steady because home prices haven't moved very much. But that apparent stability shouldn't automatically be seen as a sign of strength. In many cases, a long period of flat prices is exactly what happens before a market begins to weaken. The median home price in Jacksonville is sitting at roughly $390,000, showing very little change from a year ago. On the surface, that sounds reassuring, but with inflation still running above 3%, homeowners are already losing purchasing power in real terms, even if prices appear unchanged. The more important warning signs are found beneath the headline, numbers. Pending home sales have fallen by nearly 14% compared with last year. Since pending sales often reflect future completed transactions, this is a leading indicator that has historically signaled additional price weakness several months later. At the same time, the supply of homes on the market has climbed back to levels last seen in 2019, effectively eliminating the inventory shortage that once gave sellers a significant advantage. Homes are now taking an average of more than 65 days to sell, compared with only about 18 days during the peak of the pandemic housing boom. That change alone has shifted negotiating power away from sellers and back toward buyers. Much of Jacksonville's rapid growth was driven by what many viewed as an affordability advantage. Buyers relocated from expensive parts of South Florida and high-tax states in the Northeast because Jacksonville offered lower housing costs and a more affordable lifestyle. That competitive edge, however, is disappearing. Home ownership expenses continue to rise across Duval County. Average annual homeowners insurance premiums have climbed into the $4,000 to $4,500 range, more than double what many owners were paying before 2020. Updated flood risk assessments and a more cautious reinsurance market are making insurance both more expensive and more difficult to secure, increasing the financial burden on homeowners. Many expected stronger job growth to offset those rising costs, but that hasn't happened as quickly as anticipated. Expansion in sectors such as banking, logistics, and healthcare has fallen short of earlier projections, while wage growth has remained below 4%. For many households, income simply isn't increasing fast enough to keep pace with today's much higher mortgage payments. Investors are also becoming more cautious. Rental listings are increasing, rents are beginning to soften, and the numbers no longer produce the same attractive cash flow they did during the boom years. As returns shrink, fewer investors are willing to buy additional properties at current prices. Jacksonville isn't experiencing a dramatic housing crash that's making national headlines. Instead, it's slowly moving toward an oversupplied market without a clear source of new demand to reverse the trend. That may be one of the riskiest situations a housing market can face, because once enough sellers realize that buyers have stepped away, prices often don't decline gradually. They adjust much more quickly until the market finds a new balance. Number 6. San Antonio, Texas. San Antonio is no longer experiencing the rapid price growth that defined the housing boom. Instead, the market is cooling in an uneven way, and that's often how extended housing slowdowns begin. Although home prices have fallen by only about 5% to 6% from their peak, the numbers beneath the surface suggest a much more significant shift is underway. One of the clearest warning signs is how long homes are taking to sell. Among the nation's major metropolitan areas, San Antonio now ranks as one of the slowest markets, with the average property remaining on the market for around 83 days before finding a buyer. At the same time, completed home sales have declined by more than 10% compared with the previous year, even as new listings continue to increase. That growing gap between supply and demand is becoming harder to ignore. Unlike markets such as Austin or Dallas, San Antonio doesn't have a large concentration of extremely high-income buyers capable of supporting elevated home prices. The median household income is approximately $63,000, while the median home price remains close to $310,000. As borrowing costs stay high, that affordability equation is becoming increasingly difficult for many families. The local economy also depends heavily on a relatively small number of industries. Nearly 1 out of every 5 jobs is connected, either directly or indirectly, to the military, tourism, or healthcare. Each of those sectors is facing its own challenges. Uncertainty surrounding future federal spending has raised questions about military expansion. Tourism activity has begun to cool, and many healthcare organizations have slowed hiring. When a regional economy lacks broader diversification, housing demand can weaken more quickly as economic conditions change. Home builders are already adjusting to this new environment. Incentive packages worth 6% to 9% of the purchase price are becoming increasingly common. Rather than lowering advertised prices outright, builders are offering mortgage rate buydowns, upgraded finishes, or other financial incentives that quietly reduce the true cost of buying while allowing headline prices to remain relatively unchanged. The rental market is also showing signs of losing momentum. Rent growth has largely leveled off, housing inventory continues to expand, and investors who once expected San Antonio to deliver appreciation similar to Austin are beginning to reconsider those expectations. San Antonio isn't the kind of market that typically falls apart because of speculative excess. Instead, its greatest challenge is affordability. Once buyers recognize that prices are no longer climbing automatically, the urgency to purchase begins to fade. And when that sense of urgency disappears, market forces tend to take over, allowing prices to adjust more naturally until they better reflect what buyers can realistically afford. Number 5. Tampa, Florida. Tampa's housing market is no longer showing only subtle signs of weakness. The slowdown has become increasingly visible, and the driving force isn't fear or changing sentiment. It's the rising cost of owning a home. Financial pressure, more than anything else, is steadily reshaping this market. Since reaching its peak in 2022, home prices in Tampa have fallen by nearly 9%. The pace of that decline picked up noticeably in early 2025, including a monthly drop of around 1.6%, making it one of the sharper one-month declines recorded among major U.S. housing markets. Moves of that size are rarely associated with a healthy and balanced market. The biggest challenge facing homeowners today isn't just the purchase price of a house. It's the ongoing expense of keeping it. Tampa now ranks among the most expensive places in the country for homeowners insurance. The average owner of a $300,000 home is paying roughly $5,100 each year for insurance, more than twice the national average. For many families, that single bill now exceeds the combined cost of utilities, internet service, and auto insurance. Once property taxes and homeowners association fees are added to the equation, the total monthly cost of ownership becomes difficult for many households to sustain, even if the home's purchase price hasn't changed dramatically. The supply of available homes tells a similar story. Across the Tampa-St. Petersburg-Clearwater metropolitan area, active listings have increased by more than 30% compared with the previous year. As competition among sellers intensifies, price reductions are becoming increasingly common. More than 52% of homes currently on the market have already had their asking price lowered at least once. Homes are also taking much longer to sell. During the height of the housing boom, many properties found buyers in fewer than 20 days. Today, it's common for listings to remain on the market for more than 70 days before going under contract. The short-term rental market, which once helped support property values, is also losing momentum. Occupancy rates have dropped by roughly 20%, average nightly rental prices continue to decline, and new regulations are making it more difficult for owners to generate the profits they once expected. Many investors entered Tampa believing the area's growing tourism industry would provide an endless stream of demand. Instead, they're discovering that financial fundamentals eventually outweigh optimism. Higher operating costs and lower rental income are making many investment properties far less attractive than they appeared just a few years ago. Tampa didn't suddenly lose buyers because people stopped liking the city. It lost momentum because the cost of owning property has risen faster than many households can reasonably afford. When holding onto a home becomes increasingly expensive, selling is no longer simply a personal decision. It often becomes a financial necessity. And that's the point where ordinary market slowdowns can quickly turn into much sharper corrections. Number 4. San Francisco, California. San Francisco's housing market has moved beyond a typical correction. What we're seeing now is a long-term adjustment as the city adapts to a very different economic reality. Rather than preparing for another period of explosive growth, the market is being reshaped by a future with slower demand and a smaller base of buyers. Across the San Francisco-Oakland-Fremont metropolitan area, home values have fallen by more than 10% compared with a year ago, making this one of the sharpest declines among major housing markets in the United States. Yet despite those losses, the median home price still sits around $1.3 million. That's the challenge facing the market. Prices remain extremely high even after a significant decline. The city's biggest advantage during the housing boom was its powerful growth engine, but that engine has weakened considerably. Since 2020, San Francisco has lost more than 7% of its population, while employment in the technology sector has continued to contract. At the same time, office vacancy rates remain close to 25%, suggesting that many of the high-paying jobs once concentrated in the city may never return at their previous scale. Without a steady flow of highly compensated workers, demand for expensive homes naturally begins to fade. Even when prices fall from their peak, fewer qualified buyers are available to take advantage of those lower prices. Meanwhile, the number of homes for sale continues to rise. Active inventory has increased by roughly 35% over the past year, while many buyers remain cautious about entering the market. Luxury homes are feeling the pressure even more, with properties in the $3 million to $5 million range often sitting unsold for months. Price reductions at those levels are becoming increasingly common rather than unusual. Many homeowners are learning that lowering the asking price is no longer enough to guarantee a sale. When the overall pool of buyers continues to shrink, even substantial discounts may not generate the interest sellers expect. The cost of ownership also remains exceptionally high. Property taxes, homeowners insurance, earthquake retrofit requirements, and ongoing maintenance can easily push monthly ownership expenses above $10,000 for many properties. At the same time, rental income is no longer increasing quickly enough to offset those rising costs, making investment properties less attractive than they once were. San Francisco's housing market isn't simply recovering from a speculative bubble. Instead, it's adjusting to a changing reality. A city that once thrived on rapid population growth, technological innovation, and constant economic momentum is now dealing with outward migration, corporate downsizing, and softer housing demand. Home prices don't always fall because people panic. Often they decline because fewer people need or choose to live there, reducing the demand that once supported higher valuations. Number 3. Phoenix, Arizona. Phoenix is going through one of the sharpest housing market reversals in the United States, and the main reason is something many people didn't expect. Buyer demand disappeared much faster than the housing supply could adjust, leaving the market badly out of balance. Across the Phoenix-Mesa-Chandler metropolitan area, home prices have fallen by more than 10% compared with a year ago. And since late 2024, nearly 87% of homes have experienced a decline in value. This isn't a temporary slowdown affecting only a handful of neighborhoods. It's a broad market contraction that's spreading across the region. For well over a decade, Phoenix relied on one powerful source of growth: a steady stream of new residents moving into the area. That trend is now changing dramatically. Net domestic migration dropped from roughly 32,600 people in 2022 to fewer than 2,000 by 2024, bringing an end to a 13-year period of sustained population growth. When population growth comes to a halt, housing markets often lose momentum much faster than expected. In Phoenix, that shift has been especially noticeable because construction continued even as demand weakened. Home builders kept adding new inventory, and the number of active listings has climbed to nearly 15,000 properties, compared with around 10,000 a year earlier and almost 4 times the exceptionally low levels seen during the pandemic boom. Affordability has also become a growing obstacle. The median home price remains close to $430,000, but despite recent price declines, monthly mortgage payments are still roughly 70% higher than they were in 2019 because of elevated interest rates. Owning a home has become even more expensive due to rising utility costs. During Arizona's hottest months, many households regularly face electricity bills of $350 to $400 per month, creating an additional financial burden that homeowners in cooler climates often don't experience. Long-term concerns about water availability are also becoming more than theoretical. Questions surrounding future water supplies are increasingly influencing lending decisions, insurance assessments, and the overall perception of long-term housing risk in the region. Investors are quietly stepping back as well. The supply of short-term rental properties has expanded significantly. Rental price growth has flattened, vacancy rates are increasing, and many owners are finding it more difficult to generate the returns they expected. Neighborhoods that once attracted fierce bidding wars are now seeing frequent price reductions. Nearly half of all active listings have already lowered their asking price at least once in an effort to attract buyers. Phoenix's housing boom wasn't supported primarily by rapid income growth. Instead, it depended heavily on continuous population inflows. As that migration has slowed and in some cases reversed, the market is facing a much tougher reality. More homes are available, fewer buyers are entering the market, and the overall cost of ownership continues to rise. Housing markets don't ignore those fundamentals. Over time, prices adjust to reflect them, no matter how optimistic expectations may have been during the boom. Number 2. Austin, Texas. Austin's housing market didn't simply lose momentum. It shattered the story that fueled one of the biggest real estate booms in the country. For years, the city was held up as the perfect example of unstoppable growth. The common belief was that home prices would keep climbing, technology companies would continue expanding, and a constant wave of newcomers would guarantee endless demand. Today, each of those assumptions is being put to the test. Since reaching its peak in 2022, home values in Austin have fallen by more than 14%, making it one of the steepest housing declines among major U.S. metropolitan areas. The typical home price has dropped from the mid-$500,000 range to roughly $430,000, erasing several years of appreciation in less than 3 years. Perhaps even more telling, Austin recorded one of the largest month-to-month price declines among major housing markets in late 2024. That wasn't a sign of a market finding its balance. It suggested that the downward trend was gaining momentum instead of slowing. The increase in available homes helps explain why. Compared with the exceptionally tight market seen during the pandemic, active listings have more than doubled. A city that once relied on limited inventory to keep prices rising is now facing the opposite problem, with far more homes competing for a shrinking pool of buyers. Properties that once attracted offers within 7 to 10 days are now commonly remaining on the market for 75 to 90 days. To generate interest, sellers are increasingly reducing their asking prices. More than 45% of current listings have already undergone at least one price cut, and many have been discounted multiple times. The technology sector, which played a major role in Austin's rapid expansion, is also facing new challenges. Layoffs, slower hiring, and the growing number of companies requiring employees to return to the office have reduced the number of well-qualified buyers entering the market. Meanwhile, the cost of owning a home continues to increase. Following property reassessments, taxes in Travis County have risen by roughly 20% to 30% for many homeowners, pushing monthly housing costs higher even as property values decline. Insurance premiums and homeowners association fees have also continued climbing, making affordability an even greater obstacle. Home builders are among the first to respond to these changing conditions. Many are now offering incentives worth 8% to 10% of the purchase price, including mortgage rate buydowns, direct price reductions, and other financial concessions designed to attract buyers. Those incentives are less a sign of confidence than an indication that inventory is building faster than demand. Once builders begin lowering effective prices, Owners of existing homes often have little choice but to follow.